2026 is shaping up to be one of the most strategically important years for dealer groups. Not because of one big disruption, but because margins, capital cost, OEM unpredictability, and tighter buyer discipline are all converging at the same time. With election year policy uncertainty and tariff discussions added into the mix, dealers want clarity about where the market is actually heading. That's why we're speaking with Alex Watterson with the Presidio Group today. The Presidio Group is one of the longest standing automotive investment banks, nearly 30 years in the industry, over 290 completed transactions, and more than $19.5 billion in total deal value. They see trends in buyer behavior across the country that most dealers never get access to. And what they are seeing has major implications for leadership, structure, and value heading into 2026.
Before we talk about 2026, where it's going, I think we should talk about where we are right now heading into 2026. Dealers are still making double what they were making in 2019. The super cycle of outsized earnings as a result of the supply and demand imbalance during COVID, it's over, it's gone. Profitability looks like it's stabilized. Dealers transacting are not worried about catching a falling knife. We're officially in this new normalized operating environment. We think the sweet spot is around 16 million SAR. So if production over what's required for that increases, then grosses are going to come under pressure. If production is below that, then grosses could also increase. So it all depends on whether these manufacturers are going to remain disciplined. But I think the best way to really get a pulse on 2026 is from the dealer body. And we recently polled dealers representing 3,000 dealerships, and 68% of dealers expect earnings to maintain or to increase during 2026. So even with the uncertainty around new vehicle margins and the impact of tariffs, dealers are still very optimistic for the next few years, which is going to help drive the M&A demand. Close to 60% of dealers polled are interested in buying more dealerships in 2026. So there's still a lot more buyers than sellers in the market. I will say buyers are continuing to be a little more selective on what they are acquiring versus 2020 through 2023. Brand and geography are still the primary driver, as well as the operational team and what the technology stacks look like and how it fits into the long-term goals of the buyer and their group. But overall, we expect 2026 to be an active year for M&A, and the opportunity is there for groups who are prepared.
So, Alex, what makes dealers attractive in this market?
That's a great question. I'll try to answer it in two parts because it's really about earnings and human capital. Earnings stability is always one of the top drivers. Dealers typically have four levers they can pull when it comes to dealership profitability, and that's new, used, F&I, and fixed operations. Even with all the uncertainty around new vehicle margins, the remaining three levers is what dealers are focused on right now when it comes to gross profit. 85% of the polled dealers believe parts and service will be the biggest driver of their business in 2026. Close to 50% of dealers think used vehicles is going to be a big driver of profitability for 2026, with more off-lease vehicles becoming available. And then F&I, the average dealer is making about a 1,700 PVR. And so there's an opportunity there for a lot of dealers. Dealers are pulling these levers to offset any uncertainty on the new vehicle side. And those that are doing so are making their dealerships very attractive for potential buyers. Do they have the right amount of bays to grow fixed operations? Do they have room real estate-wise for additional volume? And do they have the right tech in place to support all this? That's all things dealers should be asking themselves. As far as human capital goes, another change we've seen is that buyers are evaluating dealerships differently than they used to. We used to call dealers up and they say, send me the P&L, and that's all I need. It's completely different now. They're not just focused on the P&L. Most dealers don't have a busload of people to replace everyone at the dealership. So they're putting a lot of value into the existing personnel and structure. Buyers are focusing on leadership depth, operational consistency, cultural stability, executional stability, and alignment among owners, family, and key managers. These factors influence valuation, deal certainty, speed to close, and deal terms. We have seen strong deals stall or lose significant value, not because of financial performance, but because of leadership or alignment risks inside the organization.
Exactly. Leadership structure has become a valuation driver. The business relies too heavily on one person, whether that's the GM, controller, or owner. What I've seen, what I've heard from you guys is buyers discount that for risk. Even if you're not selling, lenders and partners evaluate the business the same way. Where are dealers exposed?
I think one of the most common risks we see is a lack of diversification. Sure, I would take 5 Toyota stores. I'd trade my kids for 5 Toyota stores in Florida. But hypothetically, what would happen if Toyota was hit with the same cyber attack that crippled JLR for a couple months? Or what would happen if a massive hurricane, tore through Florida? I hope none of that stuff ever happens, but having all your eggs in one basket is a big risk. And so dealers should be thinking about their exposure. Some of the other common risks we see with dealers is an overloaded or irreplaceable GM, unclear next-gen roles or readiness, no continuity plan for key operators, misalignment between family members, and a lack of clear governance. These issues can create uncertainty, and uncertainty reduces value.
Yeah, and inside these stores, these same issues show up as friction, slow decisions, inconsistency, and heavy pressure on the dealer. The business becomes operationally successful, but strategically fragile. What are high-performing dealer groups doing now?
Yeah, portfolio management is what the high-performing groups are doing right now. They're taking a look at their existing assets and evaluating if they fit into ownership or the group's long-term strategy. Are these the brands we believe in? Are these the markets we believe in? We always talk about the 80-20 rule. Where are the bottlenecks? Where is management spending most of their time trying to fix underperforming stores at the bottom of their portfolios? And so when you evaluate these assets, does it make more sense to divest of some of the assets and redeploy that capital to an area of higher return and free up management's time to focus on the other 80%? Technology is playing the largest part it ever has in retail automotive. 93% of dealers polled have or plan to expand software use, primarily AI tools, and they expect to see increased productivity and improve customer engagement. So it's a win for the dealer and for the consumer. I think dealers are also spending a lot of time getting their houses in order. They're taking a look at long-term strategic direction, building leadership depth in the GM, controller, and department head roles, establishing clarity around roles and responsibilities, strengthening culture to retain top talent, and ensuring the business can operate without the owner present each day.
Yeah, and from the leadership and continuity side, the high-performing groups we work with are also using management advisory boards to align leadership and reduce bottlenecks, applying behavioral and communication insights to reduce conflict and improve collaboration, implementing governance and decision authority frameworks to protect the family from the business and vice versa, creating next generation development pathways, establishing clear owner, GM, manager communication cascades, and planning for bench strength in key positions. Also building continuity plans for unexpected transitions, implementing consistent leadership meeting rhythms, developing present state and future state organizational charts. These structures create stability, clarity, and alignment that improve performance today and protect enterprise value tomorrow.
Exactly. When internal structure and financial strategy are aligned, dealers can grow, acquire, or position themselves for opportunities with much greater confidence.
So what final comments do you have, Alex?
I think the 2026 market will favor the groups that are structured, aligned, and strategic. Not necessarily the largest groups, but the most prepared. You got to remember, 9 out of 10 buyers are still private buyers.
Thank you so much for joining me today and sharing Presidio's insight and your insight on the automotive state of the union as it is today. And if you as a dealer are wanting a clear understanding of where your dealership stands, whether leadership, structure, long-term continuity, take the Dealer Growth and Continuity Scorecard or schedule a 15-minute readiness review. It will show you exactly where your strengths are and where you may be exposed.